Hi friends, welcome once again to my channel. Today we are discussing the concept of leverages in financial management. The concept of leverage is mainly taken from the physics. According to physics, a lever amplifies a small input force to provide a greater output force, which is said to provide leverage. In other words, when we are applying a small force on the lever, it moves big things or big weights. A weight which we cannot move directly, we can move easily by using a lever. In financial management, leverage is an investment strategy of using borrowed money to increase the potential return of an investment or the return of the equity shareholders. Capital structure is the combination of capital from different sources of finance. A firm's capital normally comprises of equity share capital, preference share capital, retained earnings, and debt. Debt is a cheaper source of finance than the equity because of the following reasons. One, lenders have a claim from the company, and even if the company is on a loss, they can claim their interest, so they have a lesser risk than the equity shareholders. Second one, the interest on debt is a tax deductible expenses, and the company is paying a lesser tax on because when the company is paying interest, it is paying less taxes. Third one, issuing and transaction costs associated with raising and service of debt are generally less than the ordinary shares. Leverage refers to the ability of a firm in employing long-term funds having fixed costs to enhance returns to the owners. A firm with debt fund in capital is called a levered firm, and a firm with no debt in the capital structure is called an unlevered firm. Leverage in financial analysis studies the influence of change in one financial variable over some other related financial variable. Let us consider an example of firm A and firm B. Both are having a total capital of 2 lakh rupees, but B is employing a debt capital at 10% for 1 lakh, whereas firm A is fully equity financed. So B is levered firm and A is an unlevered firm. The EBIT of both firms is 24,000, and the interest in the case of B is 10% of 1 lakh is 10,000, and the earnings before tax is 24,000 and 14,000 respectively. Tax at 30% works out to be 7,200 and 4,200, and the profit after tax is 16,800 and 9,800 respectively. So when we calculate the percentage return on equity, it comes 8.4% for firm A and 9.8% for firm B. So with the leverage, the firm B is better off as far as the equity shareholders are considered. EBIT is 12% of the total capital, that is 2 lakh into 12% is 24,000. Here the firm made a operating profit of 12%, but the company paid only 10% to the debt holders, and the 2% is accumulated to the equity shareholders. That is the concept of leverage. Risk is the chance of variation in the expected result causing loss or injury. In financial management, risk is the chance that the investment gain will differ from the expected return. It may be a lesser profit or it may be even loss. In the financial management, the risk can be divided into two, that is business risk and the financial risk. The risk associated with the firm's operation is called the business risk. The chance of EBIT is lower than the expected. So it is something related with the operations of the business or the efficiency of the business, and it depends upon the market conditions. And the financial is the additional risk the company is taking due to the use of the debt. When we are using the debt, we need to pay the interest even if the EBIT is less than expected or the company is going on loss. So if the company is not making the operating profit, even then we have to pay the interest. It is an additional burden to the company. That is called the financial risk. Leverages can be divided into two, operating leverage and financial leverage. Operating leverage may be defined as the employment of an asset with a fixed cost in the hope that sufficient revenue will be generated to cover all the fixed and variable costs. The use of assets for which a company pays a fixed cost is called operating leverage. With a fixed cost, the percentage change in the profits accompanying a change in volume is greater than the percentage change in volume. That means when the volume of the business increase by 10%, the profit will be increased by more than 10%. That increase is measured by the operating leverage. Financial leverage may be defined as the use of funds with a fixed cost in order to increase earnings per share. It is the use of company's funds on which it pays a limited return. Financial leverage involves the use of funds obtained at a fixed cost in the hope of increasing the return to the common stakeholders. That means if the company is borrowed at 10% and the company is able to make 12%, and the 2% difference will be accumulated to the equity shareholders. So the basic condition for a favorable financial leverage is that the company should be able to make a return which is more than the cost of the debt. Operating leverage can be found out by using the formula contribution divided by EBIT, where contribution is equal to sales minus variable cost and EBIT or earnings before interest and tax is equal to contribution minus fixed costs. Degree of operating leverage can be calculated by dividing the percentage change in EBIT by the percentage change in the sales. You remember the formula for operating leverage was contribution divided by EBIT. Here it is EBIT divided by percentage change in the sales. Why it is so? The reason is that the percentage change in the contribution and the percentage change in the sales is the same. And we will be more interested in knowing the effect of percentage change in the sales on EBIT and not the contribution. That's why the formula is designed as percentage change in the sales. Now let us try to understand the operating leverage better with the help of an example. In the example I have given 3 levels of sales: 10,000 numbers, 15,000 numbers and 22,500 numbers, and the sale price is fixed as rupees 10 and the variable cost is 4. And the contribution in the first case is 60,000, fixed cost is 30,000 in all cases, and the EBIT is 30,000 in the first case. So, as per the formula, operating leverage is equal to contribution divided by EBIT, 60,000 divided by 30,000, that is 2. What does this number 2 means? As you know, the operating leverage is a relationship between the contribution and the EBIT. So it means when there is a change in the contribution, there will be a change in the EBIT, but it will be 2 times change. As I told you earlier, the contribution and the sales varies in the same proportion. So it means for every 1% change in the sales, there will be a 2% change in the EBIT. That is the meaning of 2 operating leverage. When we say that there is an operating leverage of 2, it means that for every 1% change in the sale, there will be a corresponding 2% change in the EBIT. Let us check. So the sales is increased from 1 lakh to 1,50,000. That is a 50% increase. So according to the theory, there should be a 100% change in the EBIT. That is 50% into 2, that is 100%. As you can see, the EBIT is increased from 30,000 to 60,000. That is a 100% increase. Mind you, the operating leverage is a sales specific figure. So at 10,000 number sale or 1 lakh rupees sale, operating leverage is 2. It will not hold good for all situations. In the second situation, where the sale is 15,000 numbers, the operating leverage works out to be 1.5. That is, contribution is 90,000 and EBIT is 60,000. So the operating leverage changed from 10,000 to 15,000 numbers. Here, 1% change in the sales at 15,000 numbers will make a change of EBIT only 1.5 times. Let's check that one. From 15,000 to 22,500, the change is again 50%, but the EBIT will change only 75% because 1.5 is operating leverage at 15,000. So from 60,000 to 1,05,000, the change is 75%. This relationship works back also. From 15,000 to 10,000, the change is 33.33% down. So there will be a downward change in the EBIT also. That is 1.5 into 33.33%, that is 50%. As you can see from the figures, the EBIT is come down from 60,000 to 30,000. That is a 50% decrease in the EBIT. So the formula works both forward and backward. And again, I remind you that the operating leverage is a sales specific. On particular point of sale, it will be applicable only. Now we will check the degree of operating leverage formula. Degree of operating leverage formula is equal to percentage change in the EBIT divided by percentage change in the sales. In the first instance, from 10,000 to 15,000, the percentage change in the EBIT is 100% and the percentage change in the contribution or percentage change in the sales is 50%. So 100% divided by 50%, that is 2. So that formula also holds good. Again, checking in the second situation, from 15,000 to 22,500, the percentage change in the EBIT is 75% and the percentage change in the sales is 50%. So 75% divided by 50%, it is 1.5, and that is also holds good. The formula for finding out the financial leverage is EBIT divided by EBT. This explains the effect of change in the EBIT on EBT. When there is a change in the EBIT, there will be a corresponding change in the EBT, and the ratio, the financial leverage, explains the how many times it will affect. Degree of financial leverage is equal to percentage change in the EPS divided by percentage change in the EBIT. But in the financial leverage formula, we are dividing EBIT divided by EBT. What is that reason for the change? As we explained in the operating leverage, here also the reason is the same. Percentage change in the EBT and the percentage change in the EPS will be the same. So we are using EPS instead of EBT. So we know what is the change in the earnings per share. Whatever we are discussed in the operating leverage example holds good here also. Financial leverage also is sales specific figure. It will change according to the change in the sales value, and it will work both forward and backward. We can find out the combined leverage by multiplying the operating leverage and financial leverage, or we can substitute the formula for operating leverage and financial leverage, that is contribution divided by EBIT and EBIT divided by EBT. So it will give you combined leverage is equal to contribution divided by EBT. This leverage gives you the idea how the change in the sales will affect the earnings per share. Here the direct formula is contribution and EBT, but the change in the contribution is same as the sales, and the change in the EBT is same as EPS. So the combined leverage gives you an idea how the change in the sales will affect the EPS. Let us discuss a problem. Question. A firm has sales of 40 lakhs, variable cost of 25 lakhs, fixed cost of 6 lakhs, 10% debt of 30 lakhs, equity capital of 45 lakhs, required to calculate the leverages. This is a straightforward problem. The sales is given as 40 lakhs and the variable cost is given as 25 lakhs. So the contribution is 15 lakhs. Fixed cost is given 6 lakhs. So the EBIT will works out to be 9 lakhs. Interest at the rate of 10% is 3 lakhs. And the EBT is 6 lakhs. So the operating leverage can be calculated using the formula contribution divided by EBIT, that is 15 lakhs divided by 9 lakhs, that is 1.667, and the financial leverage EBIT divided by EBT, that is 9 lakhs divided by 6 lakhs, that is 1.5. Combined leverage can be found out either by multiplying the operating leverage and the financial leverage, or using the formula contribution divided by EBIT, and the answer is 2.5. Equity capital of 45 lakhs is given in the problem, but it is of no use. Maybe it is given to confuse you. Another small question to understand the basic concepts. EBIT 10 lakhs, fixed cost 2 lakhs, EBT 8 lakhs. Calculate the combined leverage. Combined leverage can be found out by dividing contribution by EBT, but here contribution is not given, EBT is given. Contribution can be found out from the formula EBIT is equal to contribution minus fixed cost. So contribution is equal to EBIT plus fixed cost is equal to 10 plus 20, 30 lakhs. So the combined leverage is equal to 30 divided by 8, 3.75. Another problem. Sales rupees 100 lakhs, interest per annum 10 lakhs, operating leverage 1.2, combined leverage 2.16. You are required to calculate financial leverage, fixed cost and PV ratio. We know combined leverage is equal to operating leverage into financial leverage. So 2.16 is equal to 1.2 into financial leverage, and financial leverage is equal to 2.16 divided by 1.2, that is 1.8. Now we need to find out the fixed cost. To find out the fixed cost, we need contribution and EBIT, but both are not given. So the formula for financial leverage is equal to EBIT divided by EBT. And we know the financial leverage 1.8, but we don't know the EBT, but EBT is EBIT minus 10 lakhs. So we substitute that formula. So 1.8 EBIT minus 18 lakhs is equal to EBIT, and after solving we will get EBIT as 22.5 lakhs. Once you get EBIT, we can use the other formula. Operating leverage is equal to contribution divided by EBIT. So 1.2 is equal to EBIT plus fixed cost, that is contribution, divided by EBIT. Substituting 1.2 is equal to 22.5 lakhs plus fixed cost divided by 22.5 lakhs. So 27 lakhs is equal to 22.5 lakhs plus fixed cost, and fixed cost works out to be 4.5 lakhs. PV ratio can be found out by using the formula contribution divided by sales. The contribution is equal to EBIT plus fixed cost, that is 22.5 lakhs plus 4.5 lakhs, that is 27 lakhs. So the PV ratio works out to be 27 divided by 100, that is sales, into 100, that is 27%. Next question. Prepare income statement. Financial leverage 2, interest rupees 2000, operating leverage 3, variable cost as percentage of sales 75%, income tax rate 30%. Financial leverage is given as 2, and the formula is EBIT divided by EBT. EBT is equal to EBIT minus interest. By substituting, we will get 2 is equal to EBIT divided by EBIT minus 2000. That is, EBIT is 4000. Operating leverage is 3, and contribution divided by EBIT will give you the operating leverage. So contribution divided by 4000 is 3, and contribution is 12,000. Variable cost is given as 75% of the sales, so the contribution is 25% of the sales. Sales is equal to contribution divided by 25%. 12,000 divided by 25% is equal to 48,000. Variable cost is 75% of the sales, and it is 36,000. So the fixed cost is contribution minus EBIT, that is 12,000 minus 4,000, that is 8,000. Now we can prepare the income statement as required by the question. Sales we have found out 48,000, and the variable cost is 75% of the sales, and it is 36,000. So the contribution is 12,000, and the fixed cost we found out 8,000. The EBIT is 4,000. Interest is given as 2,000, so the EBT is 2,000. Tax at 30% works out to be 6,000, and the profit after tax is 1,400. Let me add 2 more questions on the same problem. If the sale is increased by 10%, what will be the new EBT? Second one, if the target EBT is rupees 8,000, what should be the sale? As we know, the combined leverage explains the relationship between the sales and EBT. Even though the formula is contribution divided by EBT, the contribution and the sales change in the same proportion. So this ratio explains the change in the sales and EBT. Combined leverage 6 means every 1% change in the sales, there will be a corresponding 6% change in the EBT. So if the sales is increased by 10%, the corresponding change in the EBT will be 60%. So the new EBT will be 2000 plus 2000 into 60%, that is 2000 plus 1200, 3200. If the new EBT is 8,000, the change is 6,000 from the existing 2,000. That is an increase of 300%. Combined leverage is 6, and a change of 300 by 6, that is 50% in the sales, is enough to make this change. The two income statements are drawn with the 10% increase in the sales and with the EBIT at rupees 8,000 to prove the correctness of our answer. When the sale is increased by 10% from 48,000 to 52,800, our EBT is increased to 3,200 as we got earlier. And when the EBT is 8,000, the sales is increased by 50% from 48,000 to 72,000, just like we got before. So that proves our point.